Welcome to the daily update, where I'll go over the action in the market for Tuesday, September 16th, and we'll see how things look for Wednesday, September 17th. All right, well, we set an all-time intraday high, but that was set right at the open, and then we ended up going down from there and having a slight down day. We're below average with volume. Everything is all about the Fed. Now, it's not a surprise about what they're going to do. It's what are they going to say? And there's the report that they come out with. The market's really fixated on that. The market has pretty much figured in that there's going to be a 25 basis point rate cut. And we've been holding up fairly well. The market's still positive. We're seeing mainly in the intermediate term, we're seeing some things looking better, but we're also seeing some weakness in the intermediate term as well until the market feels that it has enough information to show some conviction one way or the other. Okay, so right at the open, we had a higher open. We were above R1. Now, the pivot points were not very far apart because Monday's session was not all that radical as far as the open, high, low, close. So that meant Tuesday's pivot points were not very far apart. And that means Wednesday's pivot points are not going to be very far apart either. But we did get above R1 at 66.23. So we were above the 6,600 level, but we didn't stay there. We set the intraday high right at the open. Then we declined down below the unchanged level, the daily pivot at 66.12, S1 66.05. We did find support at 6,600. So that was fairly positive right there. Prices tried to rebound, but hit resistance at the unchanged level to close slightly above S1. We were down 0.13%. I mean, this is almost unchanged, but it just shows the apprehension ahead of what's going to be happening on Wednesday. We were below average with volume. We are positive on all three time frames, and I use moving averages, 20, 50, and 200-day moving averages. We're above all of those. And interest rates did come back down a little bit. The market's not really worried about inflation right now. That could change, but the most recent reports are not really feeding into that. And it's all about the Fed in Wednesday's session. So some comments. The S&P, NASDAQ 100 set intraday highs, but ended up closing lower. And then Stephen Moran will have a voting seat at the meeting that's coming up now, that's taking place after the Senate confirmed his Fed governor nomination. And then you're not hearing much about this. At least I don't pay much attention to this myself, but a federal appeals court ruled that Fed Governor Lisa Cook cannot be fired ahead of the meeting. That'll probably be appealed. We'll see if there's more to do with that. And now, looking at the conviction in the short term, we are looking extreme with the Stochc RSI, Williams percent R, both CCI charts, stochastics. That's been that way for a few days, and that's why I say there's positive conviction in the short term. But we're still far away from the 20-period moving average in the RSI 9. That's a short-term RSI. It did decline, but it's still extreme. Intermediate term, we're still in that +3 standard deviations channel. And the Sean trend meter is declining, but still extreme. And we're also far away from the 50-period moving average. This is another one just to keep in the back of our mind. We are 10% above the simple moving average, according to this one chart that I show. When we get to that level, there's no set percentage amount, but at some point, that's when we're getting a little far away from the 200-day simple moving average. So we just want to keep an eye on those things. Usually when we get overbought, and then we're also more than 10% away from the 200-day simple moving average, that, at least over the last couple of years, has meant more of a significant decline. Just a decline, not necessarily a reversal. Right? No change to the overall scenario. The the part that the Fed's kind of fixating on right now, and the market is as well, is weakness in the employment area. Is that going to continue? But until the Fed actually comes out, the market's pretty much in wait and see mode, and there will be a rate cut in September. Now the market's looking ahead to the end of October. There's another meeting coming up in December. Are we going to see a rate cut at the upcoming meetings as well? The dollar was down and interest rates were virtually unchanged on the day. So we're still coming down with the 10-year yield, but not much of a change in Tuesday's session at 4.03%. We're still positive with sentiment, but not extreme positive. And as I've been trying to point out, this could be positive for the market. You have a lot of people that don't trust that the market should be going up from an emotional standpoint, and that's what sentiment tries to measure. That means there could still be more room to the upside before everybody becomes euphoric and, oh, it's not going to go down. It's not going to go down. Oh, I fear that I'm missing out. I better get in right now. That's when things start to get a little bit toppy. And as far as our trend, we are positive. We really haven't seen much change in the charts if you watch these videos consistently. We are strengthening with the ADX, both in the short and intermediate term. We're above the moving average. We're positive with the green line above the red line. And because of the slight down day, we're negative. And I'm still keeping the momentum at positive, though. We're still looking good under the surface, even though there is some internal weakness that we see continuing to develop. So we had a pretty long list of economic reports. Retail sales. Now, this actually shows economic strength. Came in double what they had expected, up 0.6%. They thought it would come in up 0.3%. Last time it was up 0.6%. You take out autos, it was up 0.7%, much more than the 0.3% they had expected, and up from the 0.4% from last time there. I have charts of retail sales to show you about import. We just look at these numbers mainly. Import prices were up 0.3%. Last time they were up 0.2%. If you take out oil, up 0.4%. Last time they were unchanged. Export prices came in the same as last time, up 0.3%. You take out agricultural products or agriculture altogether, same as last time, up 0.3%. Then industrial production, this is a pretty important one, up 0.1%. They thought it would be unchanged. Last time it was down 0.4%. Capacity utilization, we're still under that 80 level. Usually at 80%, that's when it's considered to be at full capacity. All the factories, trucks, trains, whatever equipment is used to produce things, it's like everything that can be used is being used. That's when we get to the 80% level, and we're below that at 77.4, which is what they expected, and also the same reading that we had last time there. Business inventories came in up as expected, being up 0.2%, the same as last time. The NAHB housing market came in at 32. They thought it would come in at 33. Last time it was at 32. Okay, so here are the core retail sales year over year. We are seeing this going up a little bit here, and that's showing some growth. And as I always say, retail sales are a huge part of the U.S. economy. Then month over month in advance, but not as strong as we had seen them in the past. Industrial production, and this also puts capacity utilization in here as well. Production on a year-over-year basis is actually going down just a little bit, but still above zero. And we did see a drop-off here on a year-over-year basis with the capacity utilization. Then here is looking at on this 80% scale here, still below the 78 range. Then industrial production, where last time it was down, this time it was up on a month-over-month basis. Then the NAHB Housing Market Index. Housing prices typically been coming down here. They're still very expensive, and it's pricing a lot of folks out of being able to buy a house. And then with the general rise in interest rates that we've seen over the last few years, that makes it a lot more expensive. But we're still hanging on to this looking somewhat positive right now. Okay, then we go over to the weekly chart. This is longer term of an overbought, oversold composite. And we're going up here, and we're at 90.06. When we get above that 90 level, we're pretty extreme. So even when you take a bigger picture look and a little bit longer term look, we're overbought according to this. And consolidated equity positioning, this is just showing that it's above zero, kind of holding steady of the last few times we've seen this chart. And then we are seeing a general loosening of the financial conditions. We're dropping down here. We're also dropping down here, and that tends to be more positive for the market. And announced share repurchases, again, they may make an announcement. It's the actual follow through that counts, and we're above the average in companies that are making announcements. And this is seen as something positive when a company is willing to spend their own money to come out and buy some of their own stock. that removes a lot of the shares from the marketplace, and it just bodes well and for that particular company. And it's also something you typically see in a more positive market environment. Then NASDAQ 100 futures positioning here. So coming down just a little bit, but still looking pretty solid overall. But we're seeing price holding up fairly well. We're seeing a little bit of a drop off here with the asset managers and leveraged funds. Fed funds rate scenario analysis. Okay, this is what's going to happen looking forward here. We'll just have to go with this. People try to forecast what the results will actually be. But again, it also has to do with what they will say. And the returns for the after the Fed, they resume cutting interest rates because it's been a while now since the Fed came out and cut rates. And this is the impact that we see on the different sectors within the S&P 500. If you're involved in some of these sectors, you may want to pause this and look at this just to see how they end up performing. Then market implied U.S. recession probability. I tend to look at the average. Yes, in yesterday's video, somebody else came out with they're like 48% chance that we're going to go into a recession. Okay. Well, this is an average of a lot of different things taken together, and we're at about 21%. So that's quite a bit lower. And the market, when you look at the charts and the different measurements that we use to see, is the market concerned about going into a recession? No, they're still anticipating that we will have a soft landing. And then a classic sign of fear, gold prices in real terms are at a record high. So they change it all around to adjust going all the way back here. We're actually breaking out from where we were. And this was a crazy time back in the late 70s. This is when we saw gold really going up. And then they adjusted this a little bit. So now we're finally back to prices on an adjusted basis of where we were at before and actually going above that. Then retail sales said the total rose 0.6%, as I mentioned, month over month, above the consensus, matching July's. Okay, in autos, it also climbed. Control group sales also increased. We're seeing year over year sales accelerated. So we're seeing pretty solid retail sales, and that bodes well for the economy. Consumer spending, the well-to-do power consumer spending. This is just showing, again, based on the income that you have, and it gives you the ability to spend more here. I'm kind of taking away here that all these lines are going up, and so we're seeing an increase overall. Then equity euphoria indicator, according to this, put out by Barclays via Zero Hedge here, we're getting right up to this dashed line here, which again, if you're a perma bull, then you're like, okay, things are looking positive. If you're a perma bear, you're like, oh, head for the hills. We're back to where we were back in the late 90s and 2000 and so forth. But according to this particular measurement, it's looking a little overextended. Then risk appetite says in typical Goldilocks regimes, our risk appetite indicators supported by growth optimism, more dovish monetary policy expectations, and that's what the market's thinking about. And we're still seeing growth. A weaker dollar. We've seen a weaker dollar for 2025. In plain terms, according to this chart, investors are not long enough. They're not in the market enough. Commentary about market exuberance is misplaced. There is no exuberance. Okay. This is about the time when we need to start being concerned about this. When people come out and say, this time it's different, and we're not exuberant right now. Now, with our shorter term indicators that we look at, yeah, you can say that. The fear and greed index, we're at 58. We get concerned if we get up to 75. But when you see statements like this, it's like, okay, now that somebody is making a more dogmatic statement, I'm going to be a little more careful about things. That's my personal take. Now, I do show this ratio over the weekend when I do the intermarket analysis video. This shows staples, which are more defensive, and then does a ratio with the S&P 500. And we are really coming down with that ratio. That means the market is not becoming more defensive. It's becoming more offensive overall, and that's positive. All right, so here is the chart. Setting the high right after the open above R1, then we came down, and it was pretty boring. We dropped down below the unchanged level, the daily pivot. We were able to hold out above S1. We did come down and touch 6,600, but then came up from that. Then the daily pivot became overhead resistance. We tried to get back up to the unchanged level again, and we dropped down. And then we ended up closing a little bit above S1. So both Monday and Tuesday, you can see pretty sleepy sessions overall. An intraday chart, not much of a change in the initial uh, overnight session for the futures, and not much of a change here. We did see some positive action. The futures had been a little bit stronger, but then again, after the market opened, we're just kind of chopping along sideways. And still looking okay here. The blue line's above the red line, not showing a lot of conviction right now, but we're not seeing a lot of weakness either with the intraday large cap growth to value chart. This is still holding up okay. The intraday growth to value chart for the S&P, we're still above the moving averages, and we have been improving going back to the beginning of September. And then looking at the growth to value, where growth was down more, everything was red. And if you're new to this, over on the left, this is growth. Over on the right, this is growth. Over on the left is value. And then in the middle would be like SPY. That's the main ETF for the overall index. So growth was down more than value for the large caps, mid caps, and down less for the small caps. And just not real happy with how this is going out. With the small caps, we've been going up, but the growth to value ratio for the small caps has mostly been going down, even though we saw a bit of a bounce on Tuesday. This is looking a little bit better. Mid cap growth to value, we're above the 50-day moving average. And a little bit of a concern here, we're still below the 50-day moving average with the growth to value ratio for the S&P, and not really breaking out right now, but not really breaking down when we look at this growth to value ratio. This is where we're seeing a little bit more positive action. Even though we came down with the discretionary to staples ratio, this has been looking more solid and showing more conviction. So we are looking okay here as far as the short-term trend. Now we're positive. The green line is above the red line. One thing to be aware of is we're getting a little close to that 40 level, and other times in the recent past, when we hit that with the green line, that's about where we at least stalled and saw some kind of a decline. You can see back here in November of 2024, we hit it and then just kind of drifted and then saw a little bit lower move. But then after that, things picked up and started to improve. And then we saw that again back in July, where we were looking pretty good. And then we had a couple of down days here. This is when the employment report came out in August and we gapped lower. We actually dropped below the 20 period moving average, but we quickly got that back. So I'm just saying this as possibly could be just a short-term shakeup if we do get up to this 40 level in the short term. A very similar thing here with the intermediate term, but we're still positive. We're above the moving average, green line above the red line. And we did drop to below average with volume. We've seen that now for both Monday and Tuesday session. Now, this is a newer chart. It's called Gamma Exposure, and it's trying to use options to figure out, okay, can we figure out any support or resistance levels based on what's happening with the options? And the flip point is 6420.8. So I'd round that to 6421. Right now we're at 6606 or 6607. So we're above that. So we're leaning more positive. If we drop below 6421, that would turn things more negative. That's one takeaway from this. Then they have what's called a put wall, which is at 6500, and we're above that. And we're even above 6600. So that could be one of the reasons why we went down to 6600 on Tuesday and then bounced up off of that. Even though it's a round number, it's psychological. We're also seeing that lining up with how some of the options are actually where the options are being purchased. So this chart, again, it's newer. I'm trying to interpret it each day. We'll try to get something out of this. Okay, and we're going up a little bit here with the VIX, back up to the moving average with the line chart and the bar chart. Still having yet to really see negative seasonality, which would be positive for the VIX, meaning the VIX is going up as stocks are going down. And we're getting into the middle part of September. And will we see the VIX start to climb from here? And as we enter the weakest two or half month of the whole year, going back to 1950. The second half of September tends to be quite weak. All right, and we're seeing a bit of a pickup here with the VIX of the VIX. This is the volatility of the VIX as it's been dancing around a little bit more. The VIX of the VIX is also coming above its moving averages. So we ticked up a little bit with this fear gauge, also a bit of a tick up with this other fear gauge. A little bit of hedging and fear coming back into the market, some apprehension ahead of Wednesday's session. And pretty much flat though with the daily equity put call ratio, and a little bit of a decline here with the 5-day chart and the 10-day chart. When these are declining, that's taken as more positive. And we're still going up, not very much here with the risk on to risk off ratio after we had been more range bound. This is improving, and that's more positive for the market. And we're still going up with the high beta to low beta. And that is positive for the market also. Seeing a little bit of a pickup above the band here with the volatility risk premium. So a little bit of fear coming in this way, but it never really went out. We've been above this band pretty much for all of September. Advanced decline line, though, this is where we're starting to see some weakness internally. We're declining based on price. We declined a little bit based on volume, but in the bigger picture, it is still positive. Also, in the short term, we're dropping below zero with the advanced decline ratio. That's the blue line. We are declining and turning a little bit negative in the intermediate term with the advanced decline ratio. And we're below zero here with the short-term advanced decline ratio based on price. We're declining, but still above zero based on volume. Seeing a bit of a mixed picture there. And we're still below zero with the 10-day advanced decline oscillator. We've been really choppy now, going back into August, so not an awful lot of conviction that way. And we're seeing a tapering off of the new highs, a little bit of an expansion of the new lows. So we're going down with the 5-day chart. We're pretty much flat with the 10-day moving average chart. Now, this is still looking okay, even though it's showing some weakness. We're still above the moving average with accumulation distribution, coming down, but still above the moving average with the boom indicator, and that's shorter term, where we're turning negative again now with the Chaikin money flow. The red line is going down, and the Chaikin oscillator continues to decline. So two of the three smart money indicators are negative, seeing some weakness in the one that's positive, but it hasn't flipped over to negative. And still positive here with the vortex. Green line is above the red line. Looking a little more negative with the 20 period moving average study. These are the stocks inside the S&P that are above their 20 period moving averages. We're dropping down below 50. That's internal weakness. And again, I've been trying to point out also, as we've been going up with the S&P, we're seeing a series of lower highs here, and now this is trailing off. And we're also declining, but still above 50 with the 50 period moving average study, declining with the 100 period moving average study, and a little bit lower here with the 200 period moving average study. Still above the moving averages, though, with our advanced decline line studies. When we look at the NYSE common stock coming right down to the moving average with the S&P, below the moving average with the mid caps and the small caps. So not an awful lot of strength when you look a little bit under the surface. This is looking good, though. The 5 period moving average of the highs and lows across the broad market, it's continuing to be above zero and advance. Then we're just kind of hanging around up here. We still have a pretty good looking chart pattern. They're going back to the beginning of August. For the most part, higher highs and higher lows above this pivot point. Still in an uptrend, but we're below average with volume. So dropping off just a little bit with the 20/50, and we're flat with the 200 period moving average study. Then this is what's showing the positive conviction in the short term. Even though we're declining, we're still extreme with the Stochk RSI, Williams percent R, CCI 14, and CCI 20, and all of our stochastics charts. Now we're turning a little more negative in the short term because we're dropping below the moving average, rolling over, but right at the moving average in the intermediate short term, still looking positive with the long short term chart. And declining, but still above the midpoint with the force index. Short-term trend still looking good based on 20 periods. We're above both of the lines, and the lines are going up. And we're still in the +3 channel with the standard deviations chart. And declining, but still above zero with the balance of power. Declining, but still extreme with the CMB composite. Still positive with the go, no-go system. Darker blue bars there. Still hanging out at the highest high value here. That's positive. And we're on day 95 of this uptrend that started back at the beginning of May, according to the Landry Light. A little further in May, the proper order said that we're in an uptrend, which we continue to be in. And we're still looking positive with the TTM squeeze. The lighter blue, and we're advancing. And just hovering slightly above zero with the ease of movement. And still positive overall with the oscillator when we look at the Arun. This means that there are more buyers than sellers. This is where we're seeing a little bit more weakness. The McClellan oscillator for the S&P, we're below zero and declining. We have also been seeing a negative divergence here with lower highs as the S&P has been going up. Now, this could all get repaired. We could have some solid up moves and take care of this, but we have to go with what we see right now. And this is showing more internal weakness in the S&P. So we're going down based on price. We're kind of still barely going up based on volume. So that's a bit of a mixed picture. And we're just barely above zero here with the NYSE McClellan oscillator. This had actually been holding up better, but we're also seeing lower highs. We've been going up with the S&P. This is setting a negative divergence here, but we're pretty much right at the midpoint right now, but we're not negative. So we're still barely going up here with the summation index based on price, and we're just chopping around here with the summation index based on volume for the NYSE. And we're seeing a bit of a confirmation here, but it's negative. We're declining with the swing trading oscillator based on price and volume. Where we had been declining based on price, we were still going up based on volume. Now they're confirming each other. But the momentum, we're trying to see some positive things here with the PMO crossing above its moving average, but we're declining based on price. We're right back up to the moving average based on volume. And so we're below 50 with the PMOs that are rising, declining with the buy signals below 50, still leveling out here and holding up fairly well with the PMOs that are above zero. Still positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR, positive with the short-term slope oscillator. Now we are a little extreme because we're getting back above this green line, and we're positive with the MACD. We're above the moving average. So in the short and intermediate term, we're actually turning back to positive, and we're seeing the long-term oscillators, TRIX and KST, begin to start to turn up. So this, from a momentum standpoint, is showing that we're switching back and looking more positive. And we're also positive with the Copic curve momentum oscillator. And we're in this green area with the Sean trend meter. And that's when we start to get extreme with this chart. And we're coming down, but we're just a little bit below 80 now with the money flow index. So now this is officially an overbought signal. Once it comes down and drops below the line again, and not really much of a change here. Still positive overall with the ultimate oscillator, still above the moving average with unbalanced volume. And we're no longer extreme with the percent B indicator. We came down a little bit below the upper band. And so, again, we spent 3 days above the upper Bollinger Band. So now this is starting to work off. And we're not extreme with the RSI in the intermediate term, but we're still looking good. We're well above 50 and just below 70, where we're still coming down, but above 70 here with the short-term RSI. And shorter term, 10, 20, 30 period moving average study, still looking good there. Still above all the plotted moving averages, but we're far away from the 20 and the 50 period moving averages. This is the boom indicator. That's an oscillator that shows us how far away we are from those moving averages, and we're still a ways away. When that happens, price at some point will have a tendency to snap back to the moving average. This is the longer term 10% chart I've been talking about. We're still over 10% above the simple moving average. And again, there's no magic percentage that we want to watch for. It's just when we get above this, and then we start to hit an overbought condition, and then we tend to see more of a pullback after that. We saw that in 2023. We saw it a couple of times in 2024. We have yet to see it in this regard in 2025. So we'll just be watching to see if we continue to go above this dashed line. It may turn into a non-event. If we see more of a pullback and we drop down back below 10%, then we're not as concerned about that. And my cat says hello if you can hear that. And we're negative with the bullish percent index. We're declining below the moving average. Not much of a change here with the NYSE bullish percent index. A little bit flat with the NASDAQ 100 bullish percent index, but still positive since it's above 50. And we're still above this R1 pivot point. We'll see if anything changes as the rest of the week plays out. And longer term, this is still a very healthy looking pattern of higher highs and higher lows. And these are weekly bars, not daily bars. Still at the upper end of the trend channel here. That might be providing overhead resistance. But you look at the trend here, we are still positive with the Heikin Ashi, Kagi chart, Renko chart, and three-line break. All of those are confirming each other. Long term, we're actually coming down a little bit with the 150 and 200. Now, this is a different way of studying this. This is more like an oscillator with fixed levels here. That's a little bit different than the other When I say 10% above the 200-day simple moving average, that's more dynamic because price is changing and the moving average is changing. And so that's why it's a little bit varied, other than it's different than what you see here on this chart. Still positive on all time frames across all the indexes. We're negative with the dollar across the board. That's where a lot of the strength has been coming from, is dollar weakness has been helping stocks. And then we see energy discretionary. That's a stronger area, but energy had a nice little bounce there. And staples were up, healthcare. These are more defensive areas overall, except for discretionary. And those are the areas that were up, where utilities got hammered pretty hard, but we were down with communication and tech. Those are the growth areas that ended up being negative. So we did set a new all-time high for the S&P as well as the NASDAQ and NASDAQ 100. And you look over here on the right, that's right at the open. And we didn't see that once the day got open, and we set it right at the open. Where discretionary had a BPI cross below 70, and we have staples having a BPI cross below 30. So seeing a little bit of weakness there, and then gold is still tending to do quite well. So when we see red in Nvidia, Microsoft, Oracle still going up, man. They had some really good news last week with their cloud, and they've just been going to the moon lately, where Apple was up a little bit. And then you look over in communication where Meta was up, but both of the Google stocks were down slightly. Amazon and Tesla were up. That's helping discretionary. So the Dow ended up being down a little more than a quarter of a percent, but still in an uptrend. Neutral though with the Elder's Impulse system. And coming down, but virtually unchanged with the NASDAQ. This has actually been holding up quite well. And on the daily side here, this is a pretty healthy looking pattern as we've been seeing this advance. Positive with the Elder's Impulse system for the NASDAQ. Also a little bit of a decline with the NASDAQ 100. Also a pretty good looking uh, pattern here with the bars, and we're still above this R1 pivot point. Positive with the Qs, looking at the Elder's Impulse system. Momentum for the NASDAQ 100 is positive. Above this trend line going back to 2009 with the NASDAQ 100 weekly chart. And just kind of chopping around right now with the small caps. They were virtually unchanged, but down slightly, where we're down just a little bit more with the Russell 2000 small caps. A lot of wait and see right now. And we're neutral with the small caps looking at the Elder's Impulse system. Mid caps down almost a quarter of a percent. Neutral with the Elder's Impulse system. The Wilshire, not an all-time high since we closed a little bit lower. It did set an all-time high on Monday. Down just a little bit here with the total U.S. stock ETF. Financial sector down almost a quarter of a percent, still above its 50-day moving average and continuing to underperform the S&P 500. FANG index down a quarter of a percent after setting a high in Monday's session. So Apple was up a little bit, and we are seeing a golden cross here above the moving averages. That's positive. And we're still above the 50-day moving average with Amazon. It was up over a percent. Microsoft down over a percent, still dealing with its 50-day moving average. Google down a little bit, but it's really been skyrocketing lately. And Meta was up 1.87% above its 50-day moving average, also in an uptrend. Nvidia down, still dealing with its 50-day moving average. And Tesla continues to go up. It's seeing some real positive action now, and we're generating a golden cross with the moving average crossover system that I use. And we're a little bit down below the 50-day moving average with Netflix. So still seeing a shorter term strengthening of the correlation between US stocks and world stocks. Also starting to resume a strengthening correlation in the longer term. And we're up, we're getting more into the mid 60s now with the price of oil, and we continue to go down with the dollar. And we're still coming down. We hit that 4% level last week, and then we bounced up off of that, and we've been coming back down. It'll be interesting to see if that gets tested again in Wednesday's session with the 10-year yield. And I'm just kind of chopping along over the last few sessions here with the 10-year based on price. But look at our growth to value ratios, looking pretty good here with the Qs to S&P, discretionary to S&P, large cap growth compared to large cap value. Above the moving average with the large caps and mid caps, improving, but still below a declining moving average with the small caps. All right, so the summary of economic projections, or SEP, that's the report that the Fed comes out with. And there's different information in there that the market's going to want to dissect and try to figure out what's going on. But when you look at everything together, we are positive. I'm still calling this overhead resistance. That's the weekly chart, where for 2 weeks now we've been above that resistance level. It's still pretty quick to call it support. I don't know. We'll see if we do see some kind of a pullback, if that ends up providing support. And then we're going to get the MBA Mortgage Applications Index, housing starts and building permits. So we're getting more housing information. But the big deal is going to be the 2 p.m. Eastern announcement from the FOMC. And then geopolitical things going on. And there's lots of them, but not really having an impact on the market. And then we'll get LEI and initial jobless claims and continuing claims on Thursday. No reports are coming out on Friday. Here's another look at the economic calendar. Seasonally, neutral to negative, so no real edge, and it's a little more negative than positive. When we go back to 2002 for September 17th, we are in options expiration, which tends to be up more than it's down, up 55% of the time, down 45% of the time, going back to 1980. And here we see a little bit of a drop off here, according to the Stock Traders Almanac chart. Then we get a little bit of a bounce after that. Then when we get into the second part of the month, a little bit deeper, this is when we see weaker seasonality. Now, we don't know if it's going to play out that way, but this is what has happened in the past. And this also shows how September is weak. This also is another chart that shows how September is not a very good month typically. And now we're getting a little bit more into the second half of September, which is the worst performing month, half of the month, going back to 1950. And this hasn't been updated in a little while here, but we're not seeing that weak seasonality that historically we do see. This also shows where we tend to be weaker in September going back to 1950. So the warning signs, I've got the three smart money indicators back over on the negative side. We're positive with accumulation distribution, although it's showing some weakness. Where we're more negative now with the Chaikin money flow and the Chaikin oscillator and the McClellan oscillator and summation index for the S&P. That's more internal and that's continuing to show weakness. And it has over the last few sessions, even when we have had up days. And the bullish percent index for the S&P, the swing trading oscillator is also negative. Both price and volume are declining. We're on the positive side. Longer term, we're seeing some shorter term weakness here with the growth to value ratio. Discretionary to staples, though, that's where some strength has been coming back into the market. And we're just barely positive with the McClellan oscillator for the NYSE. So that's still keeping the summation index positive there. The parabolic SAR is positive, as are the momentum oscillators for the S&P. And then again, I measure these a little bit different. The NASDAQ 100 and NYSE bullish percent index, they continue to be positive. I don't put shorter term moving averages on those charts. I just mainly say, okay, are they above, below 50? Are they tending to go up or are they tending to go down? EASA movement, money flow, and ultimate oscillator are positive. The vortex is positive. The momentum for the NASDAQ 100 is positive. Financial sector is positive, but as you could see, we're still underperforming the S&P 500. And then the long-term special K, both daily and weekly charts are positive. And here are the pivot points for Wednesday's session. So the conclusion is we're positive. We're above this overhead resistance. We're still asking the question, will it be able to hold? We won't know the answer to that until Friday's close. Then in the short term, we are showing positive conviction. And if we do decline, we'll be watching the 20-period moving averages to see if they provide support. Intermediate term, we're seeing some things that are looking better, but some things that are not looking better. And we are positive in the long term, but we're keeping an eye because on the 200-day simple moving average, because it's more than 10% above price. Price is above that. So we'll just want to keep an eye on that. So thank you. I hope you found this helpful. Have a really, really good day, and I will talk to you in the next video.